don't just want the news, they want the truth. What others hide, I bring to you with evidence. Politics, corruption, human rights. No filters, no fear, just facts. I don't stop until the system shakes. Hello and welcome. This is Trending Daily and I'm Makhdoom Shahabuddin. India's aviation sector is facing one of its most serious crises in recent years, as a convergence of global fuel shocks, regional tensions and domestic structural weaknesses sharply increasing operating costs. Major carriers such as Air India, IndiGo and SpiceJet have warned that the situation is becoming unsustainable, with aviation turbine fuel costs rising from a pre-crisis level of 30 to 40% of total expenses to as high as 55 to 60%. The Federation of Indian Airlines has cautioned that the industry is on the verge of closing down or stopping operations if conditions do not improve. This dramatic escalation has been driven largely by global geopolitical instability, particularly tensions involving the United States, Israel and Iran, which disrupted energy supply chains and pushed jet fuel prices from around $87 per barrel before the crisis to peaks above $260, with current levels still hovering near $235. The financial shock is being further amplified by extreme refining margins, with the jet fuel crack spread surging to about $132 per barrel, nearly 8 times its normal range. Airlines argue that this spike reflects excessive margins rather than purely crude oil costs, making the pricing environment completely non-operable. Fuel prices for international routes have jumped by approximately 73 to 75 rupees per litre since late February, while domestic price adjustments have been more gradual, creating what airlines describe as a severe imbalance between domestic and international operations. As a long result, several long-haul and overseas routes have become economically unviable. Compounding this is the depreciation of the Indian rupee to multi-year lows, increasing the burden of dollar-denominated fuel purchases, alongside broader inflationary pressures such as suppliers raise prices for petrochemicals and related inputs. Regional geopolitical tensions have further intensified the crisis. Following heightened conflict in South Asia, including developments referred to in regional discourse as Mar-Kai-Haq, Pakistan closed its airspace to Indian carriers, forcing flights from India to take longer alternate routes. These diversions add 2 to 4 hours to many westbound journeys, significantly increasing fuel consumption, crew costs, and aircraft utilization inefficiencies. Analysts describe this as a double impact, where airlines are simultaneously hit by rising fuel prices and longer flight paths, eroding profitability, increasing ticket prices, and weakening competitiveness on international routes. Domestic structural issues have made the situation even more severe. India's aviation sector operates under a high tax regime, including an 11% excise duty on ATF that rises proportionally with the fuel prices, compounding the cost burden. Industry leaders argue that elevated refinery margins, not just crude oil prices, are a key driver of the current crisis, preventing airlines from benefiting even when crude prices stabilize. In response, the industry has called for urgent relief measures, including temporary suspension of excise duties, reductions in value-added tax at major hubs, and the reintroduction of a crack ban mechanism to cap refinery margins. Meanwhile, despite restructuring efforts by the Tata Group, Air India continues to face heavy financial losses, while IndiGo has struggled with operational disruptions such as flight cancellations and staffing shortages, highlighting deeper management and capacity constraints. Globally, airlines are also under pressure, but India's situation stands out due to the combination of external shocks and internal policy constraints. Jet fuel prices in major hubs have surged, and with European prices nearing $1,500 per metric ton and airlines worldwide cutting capacity, such as Lufthansa cancelling thousands of flights and other carriers scaling back operations. However, India faces a uniquely challenging mix of high fuel dependence, currency depreciation, taxation, and and regional airspace restrictions. Adding further complexity is the emerging sustainable aviation fuel (SAF) transition. While Indian Oil Corporation is preparing to launch SAF production at its Panipat refinery, global SAF prices remain 2.8 to 3 times higher than conventional fuel, making large-scale adoption economically difficult in the current environment. With jet fuel prices averaging around $199 per barrel in recent months, more than double last year's levels, airlines are caught between immediate survival pressures and long-term sustainability goals. Despite strong long-term demand driven by a growing middle class and expanding connectivity, the immediate outlook remains uncertain. The industry has warned that without timely policy intervention, continued losses could lead to grounded aircraft, reduced connectivity, and broader economic consequences. The coming months will be critical in determining whether India's aviation sector can stabilize through policy support and market correction, or whether deeper structural reforms will be required to prevent prolonged financial distress. This is Makhdoom Shahabuddin. You were watching Trending Daily. See you in the next episode.